Now let us discuss compensation on compulsory acquisition. We learnt in the transfer definition that compulsory acquisition is also transfer. Compulsory acquisition, it is also considered as transfer. Hence, when the government comes and compulsorily acquires the property of the assessee, that also will be considered as transfer. Whatever compensation is received from the government is taxable under capital gain chapter. Compensation received from government is taxable. However, under section 10 clause 37, there is an exemption. Under section 10 clause 37, there is an exemption for compulsory acquisition. Compensation received on urban agricultural land is exempt for individual or HUF if the following conditions are satisfied. Number 1, it is only applicable to individual or HUF. Number 2, agricultural land should be used at least for 2 years before the date of transfer by the assessee, parents or HUF for doing agriculture. For doing agriculture. And number 3, consideration is determined and approved by RBI or central government. So what did I say? Under section 10 clause 37, if an individual or HUF is having an urban agricultural land, and if this urban agricultural land is compulsorily acquired by the government, then the compensation received on the compulsory acquisition is fully exempt if for 2 years before the transfer it was used for the purpose of agriculture by assessee himself or the HUF or the family members. Okay. Then other than this, all the other compulsory acquisition is 100% taxable. 100% taxable. However, there is one more thing. There are certain acts, compulsory acquisition, some special acts will be there. Using that act only they will compulsorily acquire the profit. In that act they have told that we will give you income tax exemption, then there is income tax exemption. Okay, in the special act which relates to compulsory acquisition, if the government is telling we will give you exemption under income tax, then income tax will be exempt. Then balance all the compulsory acquisition will get taxable. Sir, when is transfer taking place? Transfer is taking place when the government is compulsorily acquiring the property. But when is taxation taking place? Taxation is taking place in the year in which compensation is received. Okay, transfer upon nadakudhu, it is happening in the year of compulsory acquisition. But when is the transfer taxable? In the year in which compensation is received. Hence the taxability is pushed to the date of receipt of compensation. Date of receipt of compensation. And now listen here. Compensation are of two types: initial compensation and enhanced compensation. Sir, what is initial compensation? Initial compensation means the compensation that is agreed by the central government to give to the assessee. The initial compensation is the compensation that has been determined by the government. That is only initial compensation. Then enhanced compensation means what? The assessee, if the assessee is feeling that the initial compensation is not up to the mark, it is not satisfactory, he should be getting more value for his property, then he will go to court. He will go to court. In court he will fight with the government, and if the court tells or gives the order to give some extra compensation, this is called enhanced compensation. So initial compensation means compensation agreed by the government or determined by the government. Enhanced compensation means compensation given by court. Fine. Now, can compensation be given in installments? Answer is yes. Sometimes government can tell that we are going to give you compensation in 3 equal installments over 3 years. First year will, for 1 crore, first year will give you 33 lakhs, second year 33 lakhs, then third year will give you 34 lakhs. Like that we will give you installment. Is it possible? Answer is yes. Government can give in installment also. But if government is giving the initial compensation in installment, then when will taxability arise? Taxability will arise in the year of first installment itself. Entire 1 crore will be taxable in the year of first installment. So taxable in the year of first installment received. So entire amount will be taxable in the year of first installment itself. But if enhanced compensation is received, then it is taxable as and when received. As and when received, because if you get one installment, you will not know whether you are going to get the next installment or not. That is why whenever it is received and that year, you have to tax it. And that too, if it is received due to interim order, do not tax it. Wait till the final order is passed. Only after final order is passed, you have to tax the enhanced compensation. What did I tell? Enhanced compensation is taxed as and when received. And if it is received due to interim order, means court proceedings are going on, in between they gave an order, okay, we are looking at the proceedings, but for the time being, we feel that you have given less compensation only, so at least give them 50 lakhs. Like that, they will give an interim order. If the interim order is received and compensation is received, please wait till the final order. In final order also, if they are telling that this is the compensation, then you can tax it under capital gains. Okay. So you got the concept of initial compensation and enhanced compensation. Initial compensation given by government, enhanced compensation is given after order of court. Initial compensation, if in installment, it is taxable in the first installment. In enhanced compensation is taxable as and when received. However, enhanced compensation, if it is given due to interim order, please wait till the final order is passed, and only in the final order you have to tax the enhanced compensation. Sir, how will we arrive at the capital gain? Very simple, normal method. Just instead of full value of consideration, you are going to take what? The compensation that is given by the government. Entire initial compensation you should take. Full initial compensation minus cost of acquisition, indexed cost of acquisition, cost of improvement, indexed cost of improvement. You will get the short term or long term capital gain or capital loss. Okay, well, this figure you will get. Now let's come to enhanced compensation. When you get enhanced compensation, full value of consideration will be what? The value of enhanced compensation. From this, can you reduce the cost? Answer is no. You cannot reduce the cost because cost is already reduced from the initial compensation. So double time and all, you cannot reduce cost. What can you reduce? You can reduce transfer expenses. And in this case, transfer expense is what? Litigation expense. Litigation expense means what? Lawyer fees. Lawyer fees. And court fees. Lawyer fees, court fees. This you can reduce from full value of consideration. Balance amount will become long term or short term capital gain or loss. Here one special point. See, in enhanced compensation, no, if initial compensation is equal to long term, then enhanced compensation equal to long term. If initial compensation is equal to short term, then enhanced compensation also short term. So whatever is long term or short term in initial compensation, same nature it will pass on to enhanced compensation also. If initial compensation is long term, enhanced compensation also will be long term. If initial compensation is short term, enhanced compensation also will be short term. Moreover, when you win the case in the court for enhanced compensation, the court will direct the government to not only give the enhanced compensation, to also give the interest on enhanced compensation. Interest on enhanced compensation karna, there are two special points. Number one, entire interest on enhanced compensation is taxable under income from other sources. One special point we already discussed in PGBP chapter. In method of accounting, I told you, interest on enhanced compensation is always taxable on receipt basis. Always taxable on receipt basis. And second special point, there is a standard deduction of 50% available for interest on enhanced compensation. So for this, 50% standard deduction. So totally there are 3 standard deduction in your syllabus. One, house property 24A standard deduction 30%. Then in salary chapter 50,000 or 75,000 standard deduction in salary. And third one is income from other sources 50% of interest on enhanced compensation is standard deduction. Standard deduction. Okay. So this is the concept of compulsory acquisition. Now let us go to next case. Transfer of securities in Demat account. Transfer of securities which are there in Demat account. capital gain is applicable in the hands of beneficial owner. Beneficial owner. Now listen here. Let's say you are having a Demat account. Demat account means what? An account which is where the shares are stored in dematerialized form. You can have it with your broker, for example Zerodha or Motilal Oswal or Angel One, whatever it may be. You can have a Demat account. So your shares will be stored in Demat account. Now this Demat account is there, no? It will be there in the with the company. For example, NSDL or CDSL. They will be holding the shares on your behalf. So the shares will be with them. You are only the beneficial owner. The shares will be available with them. So the capital gain will arise in whose hands? Your hands or CDSL hands? Answer is your hands. So you are only the beneficial owner. So the capital gain will be arising in your hands. Then cost of acquisition and period of holding should be determined in FIFO method. Now listen here. Earlier there used to be the concept of share certificate. Share certificate. When there was no Demat, there used to be share certificate. In share certificate, no, they are nothing but certificates in physical form. Physical form. They are actual certificates which represents the share of the company. Now, let's say you bought a share certificate of Reliance. Okay. Then after 2 years, you bought another share certificate of Reliance. After 2 years, you bought another share certificate. This is first share certificate. This is second share certificate. Sir, can I sell second share certificate first? Can I sell it first? Answer is yes, you can sell it first. Then on this only you have to calculate the capital gain. For this you should not calculate the capital gain. But when it comes to Demat, it is not like that. In Demat, all the shares are in digital form. They go inside the Demat account and they get mixed with each other. You cannot tell when you are selling the shares out of which shares you sold the new shares, whether it was out of old shares or new shares. Hence, you should always take FIFO method. FIFO method means what? First in, first out method. First in, first out. So whenever Demat shares are sold, to compute the capital gain, you have to take the FIFO method. And listen, if the assessee is having more than one Demat account, then for every Demat account you have to calculate FIFO method separately. Every Demat separately. Because obviously Zerodha will not be having Motilal Oswal's database. They can't both combine the Demat account and see which capital gain will come first. Okay, so Zerodha, for example, I am having 100 Reliance shares in Zerodha, 100 Reliance shares in Motilal Oswal. So there FIFO will happen separately, here FIFO will happen separately. Okay. Next, section 45, subsection 3, capital asset from partner to partnership firm or member to or AOP BOI. From partner to partnership firm or member to AOP BOI. From partner to partnership. So partner is giving capital asset to partnership firm. Member is giving capital asset to AOP BOI. In such case, capital gain is taxable in the hands of partner or member, since there is a transfer of capital asset from partner to firm. Full value of consideration will be the amount recorded in the books of the firm. So in the books of the firm, whatever capital asset value you are bringing, that will be full value of consideration in the hands of partner. If immovable property is transferred and stamp duty value is more than the amount recorded in books, then stamp duty value shall be full value of consideration. Okay, so when partner is giving to the firm, in the firm's books, whatever is the value will become the sale price for the partner. Sale price minus cost price is equal to capital gain. Cost of acquisition is equal to capital gain. Then section 45 subsection 4, ulta case. Firm or AOP BOI is giving to the partner or member. So firm is giving the capital asset to partner, or AOP BOI is giving the capital asset to member. In such case, who will pay the capital gain? Firm will pay the capital gain, or AOP BOI will pay the capital gain. In such case, when the asset is transferred, full value of consideration is equal to fair market value. So they can transfer at whatever value, but you have to take what? Fair market value on the date of transfer. When what? Firm is giving the capital asset to partner. Firm is giving to partner. So when partner is giving to firm, take the value as per books of firm as full value of consideration. When firm is giving to partner, take full value of consideration as fair market value. Fair market value. Now, distribution of assets by a company in liquidation. distribution by assets by company in liquidation. Liquidation means what? Now the company is getting shut down, closed down, and the assets of the company now it is distributing to its shareholder. In such case, what will happen? I already told you while discussing section 47 that distribution of asset by a company to its shareholder will be a transaction not regarded as transfer. Transaction not regarded as transfer. So when the assets are given to shareholder from the company to shareholder, it is a transaction not regarded as transfer. Now see here, in the hands of company, distribution is a transaction not regarded as transfer. So no capital gain will arise. So when company will give the asset to shareholder, what will happen? No capital gain will arise. Now, in the hands of shareholder, what will happen? Distribution attributable to accumulated profit of the company. If distribution of the capital asset is up to the accumulated profit of the company. Accumulated profit means what? The accumulated profit that has been created in the balance sheet. Okay, if it is up to the value is up to the accumulated profit, then it will be treated as deemed dividend under section 222C, taxable in income from other sources. Sir, if it is more than accumulated profit, more than the accumulated profit, then the excess amount is there, no? See here, money received plus fair market value of the asset minus deemed dividend. That is the excess value will become full value of consideration for the purpose of capital gain. Now listen. Let's say there is a company, ABC Limited. There is a shareholder, Mr. A. Mr. A. Now, company is getting liquidation. So, company is giving asset. Let's say fair market value is equal to 1 lakh. Okay. Then, let's say accumulated profit is equal to 80,000. Accumulated profit of company is 80,000. Fair market value of asset given is 1 lakh. And for simplicity's sake, we are assuming that there is only one shareholder. Multiple shareholder na that you have to divide that much proportionate. Okay, fair market value is equal to 1 lakh. Let's say for Mr. A, the cost of acquisition is equal to 30,000. Cost of acquisition of shares is equal to 30,000. For 30,000 only he purchased the shares. Now what will happen? Now listen here. First we will see from company point of view. From company point of view, they are given 1 lakh worth asset. Asset worth rupees 1 lakh to Mr. A. This is a distribution not regarded as transfer. Transaction not regarded as transfer. Hence, for company, there will not be any capital gain. Even though it gave the assets to the shareholder, there will not be any capital gain. Now, in Mr. A's hands, that is the shareholder hand, there are two type of transaction which will happen. One is IFOS, one is capital gain. In IFOS, what will happen? The amount received up to accumulated profit. So 1 lakh is received, no? Accumulated profit is how much? 80,000. So 80,000 will be called as deemed dividend under section 222C. Deemed dividend under section 222C. Sir, what about remaining 20,000? Remaining 20,000 will become full value of consideration for the shares. See, shares also poached. Now shares are extinguished. Extinguishment of shares, that is also transfer. Hence, Mr. A has to pay capital gains tax on the transfer. So full value of consideration is equal to what? Money received minus deemed dividend. Money received or asset received minus deemed dividend. So 1 lakh minus 80,000 is equal to 20,000. So 20,000 is full value of consideration minus cost of acquisition is how much? 30,000. So capital loss is how much? 10,000. Capital loss is 10,000. So this is only liquidation. Liquidation of company. From company point of view, they need not do anything. Transaction not regarded as transfer. Sir, listen. Let's say accumulated profit is 80,000 and fair market value instead of 1 lakh, let us take it at 70,000. In such case, what will happen? Then deemed dividend will be how much? 70,000. Here, full value of consideration will be how much? It will be 0. So the capital loss will become minus 30,000. Capital loss will become 30,000. Purinjada? If it is more than the accumulated value, then it will become full value of consideration. Not more than the accumulated value, na entire amount is deemed dividend. Hence, what there is no full value of consideration. Take it as 0. Balance amount, since the shares are over, take the cost of acquisition, that will become loss. The cost to itself will become a loss. You got my point? Similar concept in buyback also. First, buyback very important, because in buyback there is an amendment and you are in the transition provision. So up to 30 September 2024, buyback provision was different. After 30 September 2024, that is from 1/10/2024 onwards, buyback provision is different. Listen very carefully. Earlier what used to happen, now what is happening, let me tell you. Earlier, see, we are more concerned about domestic company, because this is only asked in your question. Domestic company. In case of domestic company, so first and foremost, what is buyback? Buyback means what? Buyback means the company is buying back its own shares and it is giving money to shareholder. Buying back its own shares and giving money to shareholder. When the company is doing buyback, then up to 30th September 2024, when the company was giving money to shareholder, the company had to pay buyback tax. The company had to pay buyback tax. What is the buyback tax? It is 20% plus 12% surcharge plus 4% health and education cess. So total 23.296%. 23.296%. And since the company paid buyback tax, it was totally exempt in the hands of shareholders. Okay. Now listen. Buyback lenna ABC Limited is a company and A is the shareholder. Okay. So A is having shares. He is giving shares back to the company, and ABC Limited, let's say, is giving compensation of rupees 1 lakh. So ABC Limited is giving 1 lakh and A is giving all the shares back to ABC Limited. This is only the buyback transaction. So A is giving the shares, ABC is giving the buyback amount. Now, first up to 39, what will happen on this 1 lakh? They had to pay 23.296% as buyback tax. So how much? 23,296 will be paid to government. Two three two nine six sorry. Rupees 23,296 will be paid to the government. Balance how much? 1 lakh minus 23,296. 76,704 net amount. 76,704 will be paid to Mr. A. Okay, and since already tax has been deducted, no, so in the hands of Mr. A, the 76,704 will be exempt income. It will be exempt income. You get my point? Now what is happening? Let us see. This is earlier. So if the buyback is happening up to 39/2024, you have to treat like this. How I told you. Company will pay buyback tax. And buyback tax also, in what it will pay, you know. This 1 lakh I just took for simplicity sake. You have to pay buyback tax on buyback price minus issue price, including share premium. So buyback price minus issue price, the difference amount only buyback tax should be paid. That is 20 plus 12 plus 4%. And it should be paid within 14 days from the date of buyback. Now, sir, what about 1/10/2024 onwards? From 1/10/2024 onwards, when the company will do buyback, it will not pay anything. No need to pay anything. The shareholder will get the entire amount directly. Okay? Shareholder will get the entire amount directly. But listen, some illogical thing is done by the government. Now listen here. ABC Limited and A. Fine. So A is giving the shares. Let's say A Limited is giving rupees 1 lakh. Let's imagine the cost of acquisition of these shares was 20,000. Cost of acquisition of these shares is 20,000. So naturally what you should do, A is giving the shares, correct? Giving up the shares. So it is a transfer of shares to the company because the company is buying back the shares. So now it is a transfer of capital asset. So full value of consideration. I am telling what is logical. I am not telling you the provision. What is logical I am telling you. And other than domestic company, na, this provision only will apply. Okay. In the hands of A, full value of consideration is equal to 1 lakh rupees minus cost of acquisition is equal to 20,000 rupees and then capital gain is equal to 80,000 rupees. This is only logical, like this only generally the provision works, provision of capital gain works. But what is given as per the new amendment, as per the new amendment, this is not the provision. Or wait, let me just keep it. I will give you one more example. ABC Limited gave rupees 1 lakh to A. A gave shares and cost of acquisition is equal to 20,000. Now what you should do, I am telling you, buyback on or after 1/10/2024 from a domestic company, what should be done? Listen carefully. This entire 1 lakh, this entire 1 lakh is equal to deemed dividend. Deemed dividend under section 222F. New section is introduced. 222F, deemed dividend, and no expenses allowed against this dividend also. Fully taxable in IFOS. Then full value of consideration for capital gain will be taken as 0. Cost of acquisition is equal to 20,000. So capital loss is equal to 20,000. So inga vande pay the tax on gain and then treat it as capital loss. This only should be done. So this is done. What happens when the domestic company is doing buyback? It will give compensation to shareholder. In the hand of shareholder, entire compensation is deemed dividend. You pay the tax under income from other sources. No expense is allowed against such deemed dividend. And then in capital gain chapter, full value of consideration is 0. Cost is the cost of the shares. Balance amount is loss. So see here. Payment on buyback is equal to deemed dividend under section 222F. 46A, capital gain, full value of consideration for capital gain purpose is nil. Okay. If it is other than domestic company and also in case of ESOPs, normal method is followed, what I told earlier. And before also it was followed like that only, afterwards also it is followed like that only. But in case of domestic company alone, it is a little illogical, but it is only important from exam point of view, so you have to know. Because domestic company buyback is only the common buyback in country. So entire amount received on buyback is deemed dividend, and for capital gain purpose, full value of consideration is 0. Before 110, what used to happen? The company will pay buyback tax of 20% plus 12% plus 4%, and in the hands of shareholder, it used to be exempt. Okay. So if the buyback is happening up to 39, you have to treat it differently. If it is happening from 110 or onwards, you have to treat it differently. So remember the date. Okay. Now let's come to slump sale. Slump sale. Slump sale also very easy, and if it is coming in your examination, it will at least come for 8 marks. At least. Single question. Sir, what is slump sale? Slump sale means assessee is transferring entire undertaking or division for a lump sum consideration without assigning value of individual assets. So me transferring my entire business to another person is called slump sale. I am not putting value on each and every asset. I am just having a single value for business. Single value for the business. This is only slump sale. Then how to calculate capital gain on slump sale? Because now the entire business has become a capital asset. Now since separate value is not there, entire business itself has become a capital asset, or entire unit has become a capital asset. In such case, how to arrive at the capital gain? Firstly, you should know what is full value of consideration. Full value of consideration. Full value of consideration, you have to take FMV1 or FMV2, whichever is higher. FMV1 or FMV2, whichever is higher. What is FMV1? FMV1 is market value of the capital asset transferred. FMV2 is market value of the consideration received. Okay, wow. So FMV1 is what? Market value of consideration transferred, assets transferred. FMV2 is market value of consideration received. Whichever is higher will be taken as FVOC, full value of consideration. So full value of consideration is market value of assets transferred. Earlier it was only taken as what is the consideration received. Earlier it was only taken as consideration received, but now they brought a change. They brought a new rule, rule 11 UAE, United Arab Emirates. So FMV1 and FMV2 as per rule 11 UAE, you have to take whichever is higher. That is the full value of consideration. Then you have to reduce transfer expense. You will get net consideration. From the net consideration, you reduce cost of acquisition. Sir, but how to find out cost of acquisition of the entire business? Because now you are telling, see all the entire business together as a same unit. How to find out the cost? Cost is equal to net worth. Cost is equal to net worth. Net worth means what? Assets minus liability. Assets minus liability. So you will get short term or long term capital gain. Sir, short term or long term? Here also can there be long term capital gain? Answer is yes. Sir, how is the slump sale business called as long term? Long term is when the business is existing for more than 3 years. More than 3 years. And here, listen, here it is still 3 years. Period of holding concept has not changed. It is not 3 years before 22, 23 and 2 years after 23. For the entire year, it is 3 years only. For the entire year, it is 3 years only. So, only one asset will be considered as 36-month category, and that is slump sale. Okay, wow. So, after on or after 23/7/2024, there is only one asset in 36-month category, and that is slump sale. So, undertaking held for greater than 3 years, long term, up to 3 years, short term. Okay. Now, sir, what if net worth is negative? If net worth is negative, take cost of acquisition as 0. Then some special points. Whenever you are doing net worth calculation, no, you should take depreciable asset value as WDV as per income tax. Opening WDV as per income tax act. Don't take the book value. You take opening WDV as per income tax act for depreciable asset. For other than depreciable asset, you should take book value. However, if any revaluation is done, sir, the asset book value was 5 lakhs, later on it was revalued to 9 lakhs. If revaluation is done, then remove that effect of revaluation, bring it down to book value itself. So 5 lakhs only should be taken as value. Then liabilities also you have to take at book value. The balance will be net worth. Period of holding is from date of incorporation or date of purchase of the business till the date of slump sale. No indexation is allowed. So here no indexation concept I already told you. The report of chartered accountant is compulsory for indicating and certifying the computation of net worth. Okay. In the when we will do an example now. We will work out this question. Because question podambodhu da you will know why it is coming for 8 marks. எந்த பேஜ்ல இருக்குன்னு தெரியுமா? பார்த்து சொல்ல முடியுமா? பார்த்தாச்சு. Okay, see here. So first I want you yourself to calculate the capital gain. In this question, you read the question, you try to solve yourself, then we will discuss the answer. Whenever you get a capital gain question, no, whatever question it is, you first draw the format. Full value of consideration minus transfer expense minus cost of acquisition or index cost of acquisition, cost of improvement, index cost of improvement, total is short term or long term capital gain. Then if you are not able to put the figures, there is some calculation involved, you are not getting the space, na, put working note 1, adik below you start doing the working notes. That is an easy way. So full value of consideration, working note 1. Then in the working note 1 you write fair market value 1 or fair market value 2, whichever is higher. Then you put it there. Then for transfer expense you can write directly. Then for cost of acquisition you write net worth, working note 2. In working note 2 you compute the net worth. Sir, while doing the net worth also I require some calculation. You can do that itself. Or in the working note 2 you can put working note 3. No problem at all. we'll discuss. Easy only. Slum sale is like, if it comes in exams, means easy 8 marks. Easy 8 marks. So now listen here. Mr. A is a proprietor of Akash Enterprise having 2 units. He transferred on 1/4/2024, that is during previous year 24-25, unit 1 by way of slum sale for a total consideration of 25 lakhs. So what is the consideration received? 25 lakhs. The fair market value of capital asset of unit 1 as on 1/4/2024 is 30 lakhs. Unit 1 was started in the year 2005-2006. Expenses of transfer were 28,000. Balance sheet is as under. We have to compute the capital gain. Revaluation reserve is created by revising upward the value of land of unit 1. No individual value of asset is considered for transfer deed. This only shows that it is a slum sale. Then other asset of unit 1 include patent acquired on 1/7/2022 for 50,000 on which no depreciation has been charged. The value of machinery represents the written down value as per the Income Tax Act 1961. Compute the capital gain. Compute the capital gain. Now listen. So, computation of capital gain. Okay, first particulars, then amount rupees. First, what to take? Full value of consideration. Sir, please don't write FVOC in the examination, write full value of consideration. Abbreviations use panna vendam. Full value of consideration is equal to fair market value 1 or fair market value 2, whichever is higher. So it is 25 lakhs or 30 lakhs, whichever is higher. So you will get 30 lakhs. Okay. Minus transfer expenses. Transfer expenses how much? நம்ம ஃபுல்லாவே எழுதலாம். 28,000. So net consideration. How much? Minus cost of acquisition, net worth. Working note 1. Fine. So long term capital gain. Why long term capital gain? Since the asset was, the incorporation was happened during 2005-2006. You can write note, since the business began in 2005-06, which is greater than 3 years, the gain shall be, gain or loss கூட இருக்கலாம், நமக்கு தெரியல, shall be long term. Gain or loss shall be long term. Okay, இது எழுதியாச்சு. Now we'll go to working note. Working note number 1. Calculation of net worth. Net worth of unit 1. Unit 1 then. Now first assets. Assets number 1. So first, what is given in the balance sheet? Land. Land. So you should do what? 10 lakhs minus 3 lakhs. 12 lakhs. Sorry. 12 lakhs minus 3 lakhs. Sir, why minus 3 lakhs? Because you should not consider revaluation. Since revaluation has been done for this land, bring it down to the book value. 12 lakhs minus 3 lakhs. So you will take how much? 9 lakhs. Then number 2. machinery. It is given that machinery is the WDV as per Income Tax Act. So take the value of machinery as it is 3 lakhs. Then number 3, debtors. How much is the debtors? 1 lakh. Then number 4, other assets. In other assets, you have to first put other than another patent. Other than patent is equal to what? Total how much? 1,50,000 minus 50,000. So 1,50,000 minus 50,000, which is how much? 1 lakh. Then number 5, you have to take patent. Okay, wow. So purchase date is what? 1/7/2022, and the value was how much? 50,000. So minus depreciation in previous year 22-23, full depreciation 25%. 25% done. So 50,000 into 25%, 12,500. So 37,500. Then minus depreciation in previous year 23-24, 25%, 9,375. Okay, wow. Then what is the value? 28,125. So, sir, can I take 28,125? Answer is yes, because listen here, I told you it should be the opening WDV. So, as per 23-24, the closing WDV only will be the opening WDV in 24-25. So, I can take 28,125. So, now all the assets I am having. Let us put a total for the assets alone. $14,28,125. Correct, huh? Okay. Then liabilities la வந்து first one is what? கீழேந்து மேலே போலாம், மேலேந்து கீழே வரலாம், your wish. Okay, wow. But my style, I will do, you do your own presentation. Trade creditors. How much? 1,50,000 into 25%. 1,50,000 into 25%. How much? 37,500. Second one, another bank loan. How much? 2 lakhs multiplied by 70%. So which is 1,40,000. Okay. Then revaluation reserve will not come. Then capital. So capital will not form part of net worth calculation. So total of liabilities how much? Net worth is equal to 1,250,625. So this you put here, 1,250,625. $1,721,375. Correct, huh? 1721375 அவ்வளவுதான். Any difficulty in slump sale calculation? This only. If this comes in the examination, you have to solve like this. This is only the level of difficulty that will come in exam also. Okay. So if this comes in examination, it's an easy 8 marks. You can complete this question quickly also. Easily you can score 6 to 8 marks. Okay. Done. Now let's come to the theory. Section 50C. This is also important section and very simple. Important section and very simple. Section 50C. Section 50C. Listen. Stamp duty value shall be treated as full value of consideration. What people do when they are selling immovable property? No, when they are selling immovable property, they will show the value of sale as a very low value. That only will be given through white money, and balance amount is there. No, it will be given through black money. It is very difficult to catch hold of such people. Okay, what did I tell? Whenever there is an immovable property sale, generally what happens is a huge amount is given through black money instead of the taxed money. Instead of the tax money, it is given through cash instead of banking channel. So in such case, the government cannot go and red-handedly catch hold of the people. Very difficult for the government. So to escape, what did they tell? They told that we will put a minimum cap on the full value of consideration. Your full value of consideration should not go below this minimum price. So you just see what is the sale consideration into 110%. 110% of sale consideration. So the stamp duty value, if it is up to 110% of sale consideration, then take the sale consideration as full value of consideration. If it is more than 110%, if stamp duty value is more than 110%, sale consideration எடுத்துக்கோங்க, ஒரு extra 10% கொடுக்குறாங்க. Stamp duty value, the full value of consideration, அதுக்கும் கீழே இருக்கு. Stamp duty value is there, no? It is still more than this 110%, na? Then you have to take stamp duty value only. What did I tell? First take sale consideration multiplied by 110%. So 110% of sale consideration. So already you got a higher figure. Still it is not crossing stamp duty value. Then you take stamp duty value as full value of consideration. So if stamp duty value is up to 110% sale consideration, நீங்க இது மட்டும் பார்த்தா போதும். Don't even see this. You just see this. That is enough. அவ்வளவுதான் section. Stamp duty value should be greater than 110%. If stamp duty value is greater than 110%, full value of consideration is stamp duty value. Silly mistake என்ன பண்ணுவீங்க examல? You will put stamp duty value into 110%. This silly mistake students will do. This should not be done. அதுக்கு தான் திருப்பி சொல்றேன், 110% of sale consideration. 110% of sale consideration. So if stamp duty value is more than 110% of sale consideration, stamp duty value should be taken as full value of consideration in case of immovable property. In case of immovable property, that is land or building or both. Now listen, some special points. The assessee tells that the stamp duty value is more than the fair market value. Sir, I know that you have put these rules in place so that you can catch hold of people trading in black money. But the stamp duty value is such a high value. அது மார்க்கெட் ரேட் கிடையாது. ஸ்டாம்ப் டியூட்டி வேல்யூல என்னமோ நீங்க போட்டு வச்சிருக்கீங்க. மார்க்கெட்ல வந்து we cannot trade at that rate. Like that, the assessee is fighting with the department. If the assessee is fighting with the department, then the assessing officer will transfer this case to valuation officer. Valuation officer, if he tells that yes, what the assessee is telling is correct, the stamp duty value should not be that much, it should be a lesser value, then very good, you can take the lesser value as full value of consideration. Okay, but if the valuation officer is telling no, stamp duty value itself is less, the actual value is even more, then what to do? Then you take stamp duty value itself. So if you go to valuation officer, it cannot be negative for you, it will always be neutral or positive. அது மட்டும் ஞாபகம் இருந்தா போதும். When you go to valuation officer, it can never be negative for the assessee. It will be either neutral or positive. So value ascertained by valuation officer. If valuation officer ascertains the value more than SDV, then full value of consideration is equal to SDV. More than SDV na, then higher value edukka venda, take SDV. If it is less than SDV na, then take the benefit. What is the value ascertained by valuation officer that can be taken by the assessee? So what does the section say? Section says take 110% of sale consideration. Compare it with stamp duty value. If stamp duty value is higher than this 110%, full value of consideration is stamp duty value. But assessee is not happy. Assessee does not want to take stamp duty value, so he will fight with assessing officer. Assessing officer will transfer the case to valuation officer. Valuation officer will kandupudichify the value. Now this new value is there, no? It can be higher also, it can be lower also. Higher value is there, na? Ignore it, because assessee ki disadvantage irukakudadu. But lower value irukana, it is advantageous. Take it. Take it as the full value of consideration. Then generally, registration date and agreement date is the same date. Generally. However, can there be different registration date and agreement date? Answer is yes. Sir, what if they are different? What if they are different? In such case, generally registration date is only taken. However, for seeing the stamp duty value, why am I telling this registration and agreement date? For seeing the stamp duty value, you have to see which date is the transfer date. Okay, wow. Transfer date anikadana you are going to see stamp duty value. Now, registration date pakrada, agreement date pakrada. If both are different, generally registration date is only taken. But if on or before the date of agreement, if any payment is made to the seller in prescribed mode, that is account pay check, account pay bank draft, electronic clearing system or any other prescribed mode, then the assessee can take the agreement date also. Generally take the registration date, but if on or before the date of agreement any consideration is paid or even part consideration is paid through prescribed mode, the assessee can take the agreement date also. Okay. Then section 43 CA. Section 43 CA, the same concept which is there in 50C. If it is not capital asset, if it is a stock in trade, then section 43 CA will apply. If the capital asset, if the land and building are both immovable property, if it is a stock, 43 CA will apply. If it is the capital asset, 50C will apply. In both of them, rules are the same. And this is not important. Just don't learn. Okay, leave it. All the provisions are same as 50C. All the provisions are same as 50C. Fine. So very simple. Shall we also do 56-210 now? 56-210 முடிச்சிடலாம் ஒரே flowல இதே மாதிரி இருக்கிற. It is a big section. That also if we finish now, then comfortably we will finishing the entire concept. So capital gain விட்டுட்டு IFOS எடுத்துக்கோங்க. 56-210 பார்த்துக்கலாம். ஐயோ 56-210. Because similar concept, 50C, 43CA, 56-210 all come under same umbrella only. (56-210) and moreover it's very simple. 56-210 enna? Taxation of gift. Taxation of gift. Now listen here. 56-210 applies only on income from other sources. It does not apply on salary income, does not apply on PGBP income. So if any gift or any asset without a consideration or for inadequate consideration is received through employer-employee relationship or in the course or furtherance of business, then you treat it that head. Only if it is not covered in business, not covered in salary, then only you have to see income from other sources. Taxation of gift. So refer this section only other than those covered in salary and PGBP. This section is applicable to all assessees. So individual HUF company, for everyone it is applicable. We are going to see this in 3 parts. What will happen when the assessee receives cash? what will happen when assessee receives immovable property? What will happen if the assessee receives movable property? Movable property. Movable property. First and foremost, cash. Very simple. If the assessee receives cash aggregate of which is more than 50,000, then entire amount is taxable. Up to 50,000 exempt. More than 50,000 fully taxable. Fully taxable. Okay, va? Excess amount kadayadu. Full amount is taxable. Sir, but when we learnt salary chapter, I told you about perquisites. Perquisites vande up to 4,999 only exempt. 5,000 exact vande taxable. Here 50,000 varaikum exempt. 50,000 one onwards only taxable. So exact 50,000 are in the exempt. Okay. Then immovable property. Immovable property means what? Land or building or both. Land or building or both. If immovable property is received without consideration or for inadequate consideration, then if it is received without consideration, let us see stamp duty value. Stamp duty value is more than 50,000, then stamp duty value is taxable in 56(2)(10). If you have received immovable property without consideration, then you should see stamp duty value. If stamp duty value is more than 50,000, fully taxable. What is taxable? Stamp duty value is taxable. Okay. Then because you received free of cost, no. So some figure should be there, no. What is that figure? Stamp duty value. Now, assessee received the asset for inadequate consideration. Inadequate consideration, you should see stamp duty value minus consideration. Stamp duty value minus consideration should exceed 50,000 or 10% of consideration, whichever is higher per transaction. Then the difference will be taxable. See, listen here. இது கொஞ்சம் simple wordings-ல உங்களுக்கு கொடுக்கிறேன். கொஞ்சம் confusing-ஆ இருக்கு. Step 1, take 50,000. Step 2, take 10% of consideration. Okay, see whichever is higher. Take 50,000 or take 10% of consideration, see whichever is higher. Then step 3, if SDV minus consideration is greater than higher amount, then SDV minus consideration is equal to income. Step 4, if SDV minus consideration not higher than higher amount, it's lower than the higher amount, then no income. Take 50,000 or 10% of consideration, whichever is higher. Then compare this with SDV minus consideration. If SDV minus consideration is higher than the higher amount also, then SDV minus consideration is equal to income. If SDV minus consideration is not higher, then there is no income. It means what? It is adequate consideration, not inadequate consideration, adequate consideration. This means what? Adequate consideration. Basically, you should satisfy the 10% condition also, 50,000 condition also. Okay, wow. If both are satisfying or not, how to do? You just see higher of both. If it is satisfying with the higher amount, then automatically satisfied. So 50,000 or 10% of consideration, whichever is higher, compare this with SDV minus consideration. If SDV minus consideration is still higher than the higher amount, then take SDV minus consideration as income. If it is not higher, means it is adequate consideration, so there is no income. Okay. Now let's come to movable property. Movable property la JAD pass BS. Here you write V also, BSV. JAD pass BSV. So JAD pass is what? Jewelry, archaeological collection, drawing, painting, any other work of art, sculpture. B for bullion, S for security, and V for virtual digital asset. Or cryptocurrency, virtual digital asset or cryptocurrency. Okay. Other than that, if any movable property is received, it is fully exempt. Jewelry, archaeological collection, drawing, painting, any other work of art, sculpture, bullion, securities, and virtual digital asset or cryptocurrency. If this is received, then it will be taxable. If any other movable property is received, sir, I received one pen, it is fully exempt. Sir, I received a car, fully exempt. Sir, I received mobile phone, fully exempt. Okay, it is not taxable. Gift is not taxable. Only in these movable assets, gift will be taxable. Jewelry, archaeological collection, drawing, painting, any other work of art, sculpture, bullion, security, virtual digital asset. So in all these cases alone, gift will be taxable. All the other cases, whatever gift is received, how much ever amount it is received, fully exempt. It is not even covered under 56(2)(10). Now, sir, here if it is received without consideration, see the fair market value. Aggregate fair market value of all the assets combined is more than 50,000, then aggregate fair market value is taxable. If for inadequate consideration, if difference between fair market value and consideration exceeds 50,000, then the difference is taxable. Total for each and every asset, see separately, then you put all of them together. You add all of them together. First you should see what? Difference between fair market value and consideration. Then you add them all. That will be aggregate. Aggregate is more than 50,000 na, aggregate is taxable. Fair market value and consideration difference kandupidikano, 50,000 kuda compare pannu, adhigama irundhuchna taxable. Okay. Now, hence, see here, movable property other than above, no tax on gift under section 56(2)(10), no tax on EV, car, phone, watch, furniture, etc. even if the value is more than 50,000. Okay, no tax. Now, this 120% tolerance band vitrilla. Now, exception to gift, for whom and all 56(2)(10) does not apply. In the particular section will not apply to all these category of persons or all these category of transaction. Number one, section 47, transaction not regarded as transfer. Here you please write certain transaction not regarded as transfer. For example, holding to subsidiary, amalgamating to amalgamated, then partition of HUF. On these transactions and all, 56(2)(10) will not apply. Partition of HUF on these transactions and all, 56(2)(10) will not apply. Then, if any asset is received, money or asset or immovable property received from relatives, it is not taxable under 56(2)(10). Sir, yaar is a relative? Relative means so enakku na relative adu summa I wrote self. Okay va? Spouse is a relative, brother and sister relative, brother and sister of spouse relative. lineal ascendant, lineal descendant relative, lineal ascendant and lineal descendant of spouse. Lineal ascendant will be separate. Lineal descendant of spouse and the individual is same only. Okay. So of spouse, but still I wrote it here. Lineal ascendant means what? Parents, grandparents, great grandparents of individual also relative. Parents, grandparents, great grandparents of spouse also relative. Children, grandchildren, great grandchildren of individual also relative. Spouse also same only. Same children, grandchildren, great grandchildren. Brother or sister of either of parents of individual relative, but not for spouse. Okay, brother or sister. So my mother's brother, mother's sister, father's brother, father's sister, also relative. So who and all relative? Spouse, first spouse, brother and sister of individual, brother and sister of spouse, lineal ascendant, lineal descendant of individual, lineal ascendant, lineal descendant of spouse, and then brother or sister of either of parents of individual. So this is covered under relative definition. Now listen carefully. See, if someone is my relative, it is not necessary that I am also their relative. If someone is my relative, it is not necessary that I am also their relative. For example, if the brother and sister of either of parents, means what? Uncle or aunt, mother's brother is giving me gift. In my hand it is exempt. When I am receiving the gift, it is exempt. If I am giving gift to mother's brother, am I covered in relative definition? For them, who am I? For them, who am I? Brother's sister's son. Sister's son is not covered. So if I am giving them gift, it will be taxable in their hands under 56(2)(10). Purida. So relationship is not vice versa. If I am someone's relative, not necessary that they are also my relative in income tax. Okay. Next. Gift received on inheritance or will is completely exempt. Gift received on the occasion of marriage is completely exempt, but not marriage anniversary. On the occasion of marriage. Sir, is it necessary that I should receive only on the date of marriage? If one day before or one day after if I receive, will it still be exempt? Answer is yes. On the occasion of marriage. So marriage annike kadikanum avasam kadiyadu. Marriage oda occasion kaga kadikanum. It can be received a few days before or after also, not a problem. Gift received on the occasion of marriage from anyone is exempt, but marriage anniversary not exempt. Birthday party not exempt. Okay. Then gift received on contemplation of death. Contemplation of death means what? A person is on deathbed, he knows that he is going to die, that is why before dying he wants to gift some property to some person. This is called contemplation of death. Sir, what if after this he is surviving? That does not matter. Death happens or does not happen does not matter. Contemplation of death is still exempt. Okay. Local authority. Gift received from local authority is fully exempt. Then gift received from individual to a trust created solely for benefit. I just forgot to write benefit to one printing mistake. Just a second. Benefit to relative of individual. Please change this. So if I am giving a gift to a trust for my relative's benefit, then gift received by trust is exempt. If I am giving gift to trust, for what is this trust for? For benefit of my relative. For example, my son is my relative. I am creating a trust and I am putting funds inside this trust. This trust is for the benefit of my son. Then gift received by trust is exempt. Okay. Then section 1023C. Section 1023C is the exemption section. Earlier it used to be there in your syllabus, now not there. 1023C there is a list of hospitals, university, trust, etc. So if there is an organization which is covered under section 1023C, then if you receive the gift from them, then also exempt. If you give gift to them, then also exempt. Okay. Then in section 12AA, certain religious and charitable trusts are covered. Section 12AA. If an organization is registered under section 12AA, then if they give gift to you, exempt. If you give gift to them, then also exempt. Then others as may be prescribed. Others as may be prescribed, and the government prescribed also. It is relating to COVID-19. Let me just read it once and then I will summarize it for you. Okay, listen. First one is what? If an individual is receiving amount from anyone for the treatment of COVID-19 by an individual from any person in respect of any expenditure actually incurred by him on his medical treatment or treatment of any family member for the illness related to COVID-19. So, if a person was suffering from COVID-19, he got some money, that is gift, from any person he can receive that gift. In such case, some condition should be satisfied. COVID-19 positive report should be there, then proof of treatment should be there within 6 months from the date of being determined as COVID-19 positive. So COVID-19 positive report and then proof that treatment was done within 6 months of the COVID-19 positive report. So in such case, what will happen? The entire treatment expenditure is there, no, which was given as gift by someone else. See, someone sponsored the treatment, COVID-19 treatment of me or of my family. Then in such case, in my hands, it is exempt. What is the condition that I should follow? I should give COVID-19 positive report of who was ill, either me or my family member. I should give the positive report and I should give the proof of the treatment, and the treatment should happen within 6 months of the COVID-19 positive report. In such case, it will be completely exempt. The gift received by me, that is the person who has sponsored my treatment, no, it is fully exempt. And it should be given to the income tax department within 9 months from the end of the financial year. Not so important. Next, by a member of the family of a deceased person. So now, because of COVID-19, someone expired. Because of COVID-19, someone expired, and the family member is receiving a gift. Family member is receiving a gift. In such case, if gift is received from the employer, then it is fully exempt. Gift received from employer is fully exempt, and from any other person, it is exempt up to 10 lakh rupees. Exempt up to 10 lakh rupees. இவ்வளவு தெரிஞ்சா போதும். Okay. Next. Here I told you, relationship does not mean vice versa, and for HUF, relative is member. For HUF, member is the relative. Now listen here. Here also same concept. Stamp duty value. Stamp duty value you are taking, no. You should take when it is without consideration or for inadequate consideration, then 56(2)(10) will get triggered. Correct? Now registration is done, then generally registration and agreement date are same. However, if they are different and stamp duty value is also different in both the dates, generally you should take what? Registration date. But on or before the agreement date, if you have paid any money through account pay check, account pay bank draft or electronic clearing system, then you can take the agreement date also. Stamp duty value on agreement date also. And here also that valuation officer and all is there. Answer is yes. In 56(2)(10) also, if I am not satisfied with stamp duty value, I will go to assessing officer. Assessing officer will transfer case to valuation officer. Valuation officer can increase SDV or decrease SDV. Increase SDV na ignore it. Decrease SDV na take the benefit. Okay. This I already told you. Amount taxed under section 56(2)(10) will become the cost of the assessee for future capital gain calculation. Okay. 56(2)(10) is applicable only if the asset received is a capital asset. If someone is giving me a gift and if that gift is a stock for me, then 56(2)(10) not applicable. Only if it is not a stock, it is applicable. If it is not stock, not applicable. If it is stock, it is not applicable. Okay va? ஒரு question பண்ணலாம். Please solve this question number 7. Question number 7. Please solve this yourself. Now, based on whatever we have learnt, solve question number 7. Then we will also discuss the answer. So you will know what type of question is that. Long term, aggregate, short term, aggregate, related to property of the then draw format. After drawing format, read the question thoroughly and then try to fit in all the figures in the relevant places. The tricky part is just to know what to take, which figure we can take, what calculation. Be quick. Listen, we will discuss section 112 also. After that, you will know everything about this question. Then it will be even more easier to solve. Listen. Section 112. Sorry, capital gain chapter. Section 112. Section 112. In capital gain, listen here, there are 3 sections which discuss the tax rate. 3 sections which discuss the tax rate. One is for short term capital gain and 2 sections for long term capital gain. In long term capital gain, there is section 112, 112A. 112 is the general section, 112A is the special section. So whatever is covered in 112A, for that tax should be calculated as per 112A. For all the other long term capital asset, tax has to be computed as per section 112. Long term capital gain 112. Earlier, up to 23/7/2024, the tax on long term capital gain was 20%. But now from 23/7/2024 onwards, it has been changed to how much? 12.5%. So earlier 20%, but now it is how much? 12.5%. Okay, sir, the tax rate has become lower. Why is it become lower? Because now there is no benefit of indexation. Since there is no benefit of indexation, so earlier it was 20% with indexation, now it is 12.5% without indexation. Okay, but there is a special relief which is given in case of immovable property. Listen here, immovable property. In case of immovable property, there is a relief given. Any relief na? See, when the budget came, no, people started hue and cry in the market that we had purchased our immovable property for investment purpose because of the indexation benefit itself. Now the government is taking away our indexation benefit, so we are so much aggrieved that the government is not giving benefit of indexation. So the government brought a relief, but by this relief also they have cheated the public only. That also I will tell you why. But what is the relief? The relief is that indexation is gone for good. Indexation benefit from 23/7/2024, there is no more indexation. Okay, but in case of immovable property, while calculating the tax alone, you see what will be the tax with indexation or without indexation. Okay, with indexation means take 20% tax, without indexation means 12.5% tax. Whichever is lower can be paid by the assessee. Okay, if the transfer is taking place before 23/7/2024, then 20% is the tax rate with indexation. No confusion at all. After, on or after 23/7/2024, the tax rate is what? 12.5% without indexation. But the relief is given only for what? Immovable property. For immovable property, while calculating the tax alone, while calculating capital gain, you should not take indexation. Only while calculating the tax, you should take indexation. 20% with indexation, 12.5% without indexation. Whichever is lower will be the tax payable. Okay. Now, the other sections, no, you can ignore. Not that relevant from exam point of view. It is there, but not that relevant from exam point of view. Then listen here. In case of resident individual and HUF, in case of resident individual and HUF, if there is any unexhausted basic exemption limit, unexhausted basic exemption limit, it means what? Sir, my income, let's say capital gain under section 112 is 5 lakhs. Other income is only 2,50,000. Other income is only 2,50,000. Let's say I am taking new tax regime under section 115 BAC. Now, what is the basic exemption limit? 3 lakhs. Okay, wow. So in the 3 lakhs, you should adjust this 2,50,000 first. Balance is 50,000. Correct? This 50,000 is only unexhausted basic exemption limit. This unexhausted basic exemption limit of 50,000 you can use to set off this 112 income. Okay. So now this 112 income is there, no? This you can set off. So 112 only on how much? 4,50,000 you have to calculate. Resident, individual and HUF can take the benefit. For this 112 also, 112A also, 111A also, all the 3 sections this benefit is available only to resident, individual and HUF. Fine. See, this section is over. Now you come back and you complete the question. I want you to calculate the tax also. I want you to calculate the tax also. Be quick. In case of advance money forfeited, you should see whether the advance money forfeited is before on or after 1/4/2014 or before 1/4/2014. How to remember this? Pre-Modi, post-Modi. Okay, because Modi government came and only changed this provision. So from 1/4/2014 onwards, what will happen? Advance money forfeited is income from other sources. But before 1/4/2014, what you will do? You will adjust it in the cost of the asset. If you want, you can see quickly idum paathirala in the section mudichidala takkani. See here, advance money forfeited. It applies when advance money, token money or earnest money is forfeited on failure of negotiation to transfer. Advance money forfeited means what? For example, you wanted to buy my house, you gave me 1 lakh rupees as advance, but later on you told now I am not interested. So now I tell that this 1 lakh rupee I will keep with myself. This is called advance money forfeited. So this is like an income for me. So from 1/4/2014 onwards, I can treat this income as income from other sources. But before 1/4/2014, what used to happen? It should be deducted from the cost of acquisition while calculating capital gain. So in future, when I sell this house, I should reduce this 1 lakh rupees from the cost of capital asset if it was received before 1/4/2014. Now remember one thing, this reduction from cost, it should be done only if I am selling the capital asset. Okay, now listen here. Let's say in 2013, I received advance money. This is forfeited, okay, of rupees 1 lakh. So since this is before 1/4/2014, what I should do? I should adjust it with cost of acquisition while selling. But this will be adjusted only when I sell the property. Let's say I did not sell the property. I gifted the property to my daughter. And later on, let's say in 2022, daughter is selling. When daughter is selling, she will take full value of consideration as sale value. Then minus cost of acquisition. She will take cost of previous owner because she got as gift from relative. No tax under 56(2)(10). Transaction not regarded as transfer. So take cost from previous owner. Previous owner is father. Father whatever purchase price is there, you take the purchase price. But should you reduce this advance money forfeited? Answer is no. If father was selling property, you should reduce. But if other than father is selling the property, you should not reduce the advance money forfeited. This is deep point, not that relevant for examination, but still. Okay, so only for deduct only for previous owner, deduct before the indexation. So before calculating indexation, you should reduce from cost of asset. If FMV as on 1/4/2001 is chosen, then you reduce from the fair market value which you have taken. 1/4/2001 fair market value எடுத்தீங்களா, அதுல இருந்து reduce பண்ணிக்கலாம். If it is a depreciable asset, reduce from WDV. Okay, so reduce the value from the cost of the asset before indexation, after FMV as on 1/4/2001. Okay, now solve. திருப்பி படிச்சு வேற ஏதோ கான்செப்டோ விட்டு போயிருக்குன்னா சொல்லிருங்க. அது இந்த क्वेश्चन சால்வ் பண்ணிட்டு then we'll take a break. பண்ணியாச்சா? Shall we discuss? Okay, listen. Mr. Shiva purchased a house property on February 15th, 1979 for 3,24,000. In addition, he has also paid stamp duty at 10% on the stamp duty value of 3,50,000. So SDV was how much? 3,50,000 while purchasing. Purchase பண்ணும்போது SDV was 3,50,000. Very good. Next, In April 2008, Mr. Shiva entered into an agreement with Mr. Mohan for sale of such property for 14,35,000 and received an amount of 1,11,000 as advance. However, the sale consideration did not materialize and Mr. Shiva forfeited the advance. In May 2015, he again entered into an agreement for sale of the said house for 20,25,000 to Miss Deepshika and received 1,51,000 as advance. However, as Miss Deepshika did not pay the balance amount, Mr. Shiva forfeited the advance. In August 2015, Mr. Shiva constructed the first floor by incurring a cost of 3,90,000. This is cost of improvement. Then on November 15th, 2024, now we have come to the previous year. Mr. Shiva entered into an agreement with Mr. Manish. Previous year na kandipa sale nadandru. Okay, Mr. Manish for sale of such house for 30,50,000 and received an amount of 1,50,000 as advance through account pay check. Mr. Manish paid the balance entire sum and Mr. Shiva transferred the house to Mr. Manish on February 20, 2025. So this is only registration date, February 20, 2025. Mr. Shiva has paid the brokerage of 1% of sale consideration to the broker. On April 1, 2001, the fair market value of the house property was 11,85,000. Stamp duty value was fair market value was 11,85,000 and stamp duty value was 10,70,000. Further, the valuation as per stamp duty authority of such house on 15th November was 39 lakhs and 20th February it was 41 lakhs. Compute the capital gain. Okay. So computation of capital gain for this property. So first we will write the format. Computation of capital gain. Particulars amount rupees. Okay. So first take full value of consideration minus transfer expenses. Then you will get net consideration. From this you further reduce indexed cost of in the transfer எப்போ நடந்திருக்கு. This is after on or after 23/7. So indexation கிடையாது. So just take cost of acquisition minus cost of improvement. You will get how much? You will get what? Long term capital gain or long term capital loss. அது பார்த்துக்கலாம். Okay. Now let us see one by one. First, let us focus on full value of consideration. Full value of consideration should be taken as what? First, generally it should be taken as selling price. Selling price is how much? 30,50,000. 30,50,000. But as per section 50C, you have to compare this with stamp duty value. First take, put as working note number 1. Okay. So we will put working note number 1. Sale consideration is equal to 30,50,000. 110% of above is equal to 33,55,000. Now stamp duty value is equal to, now stamp duty value also what value you should take. There are two stamp duty value. One is on agreement date, one is on registration date. Registration date aniki it is higher, agreement date aniki it is lower. So it is beneficial for you to take agreement date. Correct? Now to take agreement date stamp duty value, you should have satisfied condition. What is the condition? That any consideration should be there through account pay check on or before the agreement date. Fine. So now stamp duty value will be taken as 39 lakhs. Okay. So here you should give a note. Stamp duty value of agreement date has been taken since a part of consideration was paid through prescribed modes on or before the agreement date. Stamp duty value of agreement date has been taken since a part of consideration was paid through prescribed modes on or before the agreement date. You can also write account paid check or account paid whatever. Okay, so stamp duty value. Then now here let's say you write A, B, C. Now D. Full value of consideration is stamp duty value since it is higher than 110% of sale consideration as per section 50C, or you can write as per the provisions of the Income Tax Act. Okay, wow. Hence full value of consideration is equal to rupees 39 lakhs. So this working note over. Now you go and you write it here, 39 lakhs minus transfer expense. Transfer expense is what? Broker க்கு எவ்வளவு கொடுத்தாங்க? 1% of sale consideration. So transfer expense இங்கே calculate பண்ணிக்கலாம். 30,50,000 multiplied by 1%. So is equal to 30500. Okay. So 38,69,500 is the net consideration minus cost of acquisition. Here also you can put working note number 2. Okay. So working note number 2 la go. Working note number 2. Cost of acquisition. Okay. So here you should write the provision first. If immovable property ಎಲ್ಲ ನಾ ಓನ್ ವರ್ಡ್ಸ್ ಅಲ್ಲದೆ ಹೇಳ್ತಾರೆ, you can also write in your own words. Immovable property is purchased before 1/4/2001, then assessee can take the fair market value. So write fully fair market value as on 1/4/2001 as cost of acquisition. However, such fair market value shall be restricted to, or you can write it should not be higher than, restricted to stamp duty value as on 1/4/2001. So like this, write the provision in your own words. In your own words you write the provision. Fine. So now you are going to find out. In capital gain, the calculation and all will be only for maybe 1 or 2 marks, 3 marks. All the marking is number 1 for taking the right answer, so that you don't make a silly mistake, and writing all these provisions here and there, that you know what is the concept. Okay. So immovable property is purchased before 1/4/2001. The assessee can take fair market value as on 1/4/2001 as cost of acquisition. However, such fair market value shall be restricted to stamp duty value as on 1/4/2001. Then you write all of this. Purchase price is equal to how much? Purchase price is how much? 3,24,000 plus 3,50,000 into 10%. 3,24,000 plus 3,50,000 into 10%, which is 35,000. So 324,000 plus 35,000 is equal to 3,59,000. FMV as on 1/4/2001 is equal to how much? FMV is how much? 1/4/2001 FMV என்ன? லாஸ்ட்ல கொடுத்திருக்கான். 11,85,000. Stamp duty value 10,70,000. 11,85,000 and stamp duty value as on 1/4/2001 is equal to 10,70,000. Therefore, cost of acquisition is equal to 10,70,000. Okay. So in the working note over, now you can jump to the question and write here 10,70,000. Then, do you have any improvement? Answer is yes. When was the improvement done? 3,90,000. Improvement was done in the 15-16. Previous year 15-16 improvement was done 3,90,000. So just write 3,90,000. Now what is the capital gain? 3869,500. என்ன? ஓ ஆமால காஸ்ட் ஆஃப் அக்விசிஷன்ல forfeited advance money forfeited அது கன்சிடரே பண்ணலீங்க. Why didn't you tell me before? Cost of acquisition minus advance money forfeited. Before 1/4/2014 by the assessee. Advance money forfeited by assessee only can be reduced, by any other person cannot be reduced. So assessee, how much money did they forfeit? 1,11,000. So minus 1,11,000. So cost of acquisition is equal to 1,11,000. Then you have to write provision also. If advance money forfeited before 1/4/2014 ஒரு சம் அதான் நான் ஃபுல்லா எழுதி போட்டு காட்டுறேன். that examல வந்து how you are going to present, because this same question is going to come for at least 6 or 8 marks. So definitely that much amount of provision you have to write. If advance money is forfeited before 1/4/2014, then it shall be reduced from the cost of acquisition. However, if it is forfeited on or after 1/4/2014, it shall be taxable under income from other sources. Hence, rupees 1,50,000 shall be taxable under income from other sources. Okay, 1,50,000 will be tax 1,51,000. 1,51,000. 1,51,000 shall be taxable under income from other sources. Okay, wow. Now, so cost of improvement is how much? 9,59,000. So you should write here 9,59,000. Now what is the long term capital gain? 25,20,500. Correct? 25,20,500. இப்போ இதெல்லாம் முடிச்சு now computation of tax under section 112. Okay, number 1, tax is equal to 2520,500. okay, with indexation, without indexation, whichever is lower pannulla. With indexation, tax without indexation, whichever is lower. So tax with indexation is how much? Or you can just put tax with indexation calculate panni, tax without indexation calculate panni, whichever is lower vandu you just put 1 or 2 whichever is lower and find out the answer instead of writing 2 times. Tax with indexation. So tax with indexation is how much? So first you have to find out the capital gain with indexation. Very important for exam, that is why I am working out everything on board. இதெல்லாம் சும்மா explain பண்ணிட்டு முடிச்சிட்டு I can easily go. Capital gain with indexation. Many concepts are covered in the same question. That's why I thought of giving importance. So capital gain with indexation. First, full value of consideration is equal to 39 lakhs. Then transfer expense. Here if you want you can directly take net consideration also. இதெல்லாம் எழுத வேண்டியதில்லை, directly net consideration also you can take. எவ்வளோ? So 38,69,500 minus indexed cost of acquisition. Indexed cost of acquisition, take cost of acquisition which is 9,59,000. So 9,59,000 divided by 100 multiplied by 363. Then indexed cost of improvement is equal to evlo improvement evlo 3,90,000 3,90,000. 3,90,000. It was previous year 15-16. So 15-16 previous year ku 15-16 it is 254. So take 254 divide by 254 multiplied by 363. You are getting loss. How much loss? 169,032. So tax is equal to 0. Tax is equal to 0. 169,032 tax is equal to 0. And why bother calculating in 12.5 percentage? Okay, if you want to show whichever is higher, adum பண்ணிடலாம். ஏன் அதுவும் விடுறது? Tax without indexation. How much? என்ன value? 25,20,500. So 25,20,500 multiplied by 12.5%. Next year and all, how easy it will go, it will become, just imagine. But this question will be there. This question is going to be there. They'll feel frustrated because just for this question they have to learn indexation. வேற எங்கேயும் indexation கிடையாது. வெறும் இந்த question solve பண்றதுக்காக institute will make them learn indexation. 315,063. So tax is 0. Tax is 0. Now I'll tell you the third term which is done by the government. What they have done, listen here. Indexation, no, they have removed for good, but people were requesting or demanding indexation from the government. So what they did, they just brought an amendment in section 112. They did not bring back indexation. So indexation is not there, just an amendment in section 112, that too only for resident individual and HUF who are transferring their immovable house property. That house property also should be purchased before the 23/7/2024. It should be long term. Only then you can claim the benefit of indexation, that too only in tax rate. You cannot claim it in the capital gain provision. இதனால என்ன தெரியுமா ஆகுது? First one disadvantage here itself you saw. இங்க பாரு எவ்வளவு வருது? 169,032 is the loss. Can you carry forward this loss? No. Can you set off this loss? No, because it is not a part of income. It is only a part of tax calculation. So you cannot set off or carry forward this loss. In your income, the capital gain is how much? 25 lakhs only. Moreover, one more disadvantage. I am going to teach you about section 54 series exemptions. There are various exemptions where you have to invest the capital gain amount. Capital gain amount. If it was this section, capital gain itself is not there, so no question of investment. But now how much you have to compulsorily invest? 25 lakhs you have to invest for getting the exemption in capital gain. 25 lakhs capital gain amount you have to invest. One more disadvantage shall I tell you? If in the total income, now you are going to take the capital gain as 25 lakhs. Because of this 25 lakhs, the assessor's income can cross 50 lakhs or 1 crore or 2 crore or 5 crore, because of which he is going to pay additional surcharge. That is also one disadvantage. Okay, so many disadvantages. So the government has not fully given a relief of indexation. They have only partly given by giving the relief in tax calculation. But since the income is still the higher income, many benefits are still lost. Okay, so now we will take a break.